Hey traders, Rocky here. Let's kick this off with a quick look at crude. We're going to talk a little bit about the implications for the new USO holdings on crude, which was something that happened on Monday, and talk about the American Petroleum Institute survey. And the build was smaller, which is actually slightly bullish, even mind-boggling in this environment. I'll show you another graph, which is really telling it a little bit. But the private survey shows that crude had a build of 9.9 million barrels. The expectation was about 11. All right. Gasoline, your RBOB was 1.1 million. The expectations were 2.7. So you can see that crude and RBOB are up a little bit. Now that 9.9 million and I think actually is a 1.1 million draw on gas. Now that I think about it, I might have misread that, but it's a 1.1 million draw on gas. So that went up a whole lot higher. The expectation was a 2.7 build. So again, let me correct myself. We had a build in crude of 9.9. Expectations were a build of 11. We were looking for a 2.7 million barrel build in gas. We get a 1.1 million drawdown. Drawdown's a big word there. And so RBOB is up more than crude. Now, I'll tell you what, I'd love to see RBOB move up into the April value area high, middle line of the wave. This is definitely a market that I would be open to shorting. So let's see if we can get up to that reading, because that would be a terrific setup on UGA or some RBOB puts. So back on over to crude. So now that 9.9 million barrels is really going to be tomorrow, and we'll be in the room together doing this as we are every Wednesday. We'll take a look at the Forex Factory. Here we go, the Forex Factory calendar. And what I want to point out is that I don't believe the EIA forecasts are actually what traders will look at tomorrow. When they're trying to bounce their expectations off the results of the EIA tomorrow at 10:30, they're going to not do it against 11.2, which is pretty much in line with what the API, the private number, was expecting. They're going to bounce it off this lower number, 9.9. So a smaller than expected build is not going to be less than 11.2. It's going to have to be less than 9.9. Okay, so 9.9 really now becomes the forecast that would replace this 11.2 here. All right, so I also mentioned that we saw some volatility in terms of some of the USO sort of repositioning, if you will. So let's talk a little bit about that. Okay, so jumping on over to crude, let's expand this chart here. On the 27th, if you looked at the action that we saw on the day, and that was just yesterday, the United States Oil Fund, the USO, now every time they halt, we know that they have been shaking up their holdings within the USO. Once upon a time, the USO was holding front month contracts of WTI. Now, as we saw what happened in May, they had been moving into June, July, August, September. Well, as of Monday, I think throughout that trading session, one of the things that we saw, and you can see the sell-off here, a lot of folks thought, oh, wow, that's some kind of sell-off in crude. What was that? I think some of that happened to be the fact that the USO was getting out. They were selling, they were liquidating their WTI contracts for June delivery. In other words, this very contract, they were getting out of all their front month contracts. And that was the way this fund was initially designed. WTI holds front month. Not so anymore. They're going to focus on further out contracts in an effort to, as I've been saying, keep the lights on. So it's mostly, I won't say mostly, they've got 30% July at the last time I checked, 15% August, September, October, and December. So 60%, or sorry, 70, 67, no, wait a minute. 60% of the holdings are August, September, October, and December. 10%, get this, are for the June 2021 contract, and 30% are for July. So they have completely removed any kind of vulnerability to any May-like action happening in June. So USO has been completely restructuring what they're doing. I think some of the sell-off in crude yesterday had to do with the USO basically dumping their front month. again, what they are now is just so far from what that ETF was ever designed to be. But again, they're just trying to keep the lights on. And I think that right there, that weakness had a lot to do with USO. So that portfolio, by the way, a lot of folks ask me, Rog, how big is this portfolio? It's about $3.6 billion. All right? 3.6 billion. And I think they held about 20% or so in the June contract. So that was quite a big liquidation. Something to think about. All right, so that's what we have going into tomorrow at 10:30 in crude. And by the way, in RBOB, and I'm very excited about RBOB because that move higher on, again, the 1.1 million drawdown could give us an opportunity to buy some UGA puts. Now, one of the things I mentioned when crude oil started going crazy, I said, hey, let's focus on UGA. Let's focus on heating oil. Let's focus on other things, not a straight play on crude. I still have my XLE. I still have my XOP. Both of them are, certainly away from where I would like them to be. XLE has been behaving a little bit better, just moving to the upper part of the range. Now, how do I define the range? I've been using that terminology a lot because we are, range bound. And the way that we want to simplify the range is really automate it as much as possible, but not zoom in that much. Wow, okay. So we want to automate this as much as possible. So we have this narrow Darvis, we have the value area high for the month of April, the value area low, the point of control. You can see the ranges. These are all just automated. Support and resistance automated by the Darvis 2.0. The volume profile gives us the point of control, and then the 70% of volume traded is between the red here. You can kind of see it right there, the red, and the green line. So right away, we've got the simplicity of automating the range, and that's how I identify the range. Now, we can look to the lower part of the range. That there's clearly the resistance here, but then there's support here, right, and way down here along with that. So again, that would be an extreme of the range, but just kind of where we're operating right now is clearly right in there. All right, so something to think about when it comes to XLE. It's behaving a little bit better than XOP. So next is taking a look at, and I talked about this one in the free video for a little bit, and that was looking at the NASDAQ and Goog and Google. Now, this is tail wags the dog season. These indices, S&P, NASDAQ, Dow, not the Russell, but the S&P, NASDAQ, and the Dow are high concentration weighting index futures contracts, as are their related ETFs, meaning it's a very small number of stocks that comprise an inordinate amount of the weighting. It's not a democratic even type breakdown of the 100 stocks, of the Dow 30, of the NASDAQ 100, of the S&P 500. It's a very small number of stocks that have an inordinate amount of weighting, and enter Google. So these two names, Goog and Google, would be about 8% of the NASDAQ. Now, what I'm wondering is, do we see the NASDAQ rally with Google tomorrow? I'd love to see that. One of the things that you'll notice, and we did this morning live, is when we have gap psychology in play, when we have a 4 p.m. close to 9:30 a.m. open, when that chasm is at the average to the upper end of our daily price movement range, straight from Auto Chartist, we look at this to measure what a large or high attention, high probability gap would be. Let me show you real quick. All right, so this is the Russell. And again, when we look at the 4 p.m. Eastern to 9:30 open, and that difference is at least, preferably, the average, or even ideally closer to the high, we're in business. That's what we want to see. We want to see a significant gap. I'm going to use historical price movement ranges to measure that. I'm going to use these historical price movement ranges to say, look, this is the kind of gap that's going to dominate psychology and give us the opportunity to play the 5-minute indication of our most likely direction. Now, for those of you that followed along, and we covered so much this morning, I'm not going to recap it now, but I would highly recommend checking out the first hour of this morning's opening. And this is what we did. These are the setups that we looked at. Okay? went line by line by line, showing everybody in the room, this is where I want to get short. And notice that not just on dailies do I give agro, moderate, conservative. I use that same mindset for intraday. Will I hit all those levels? Absolutely not. But I want to have different levels available to me. I don't believe the market's about going from one price to another price. I think it's about levels. And it's about understanding risk from each one of the levels. And understanding that risk allows us to position size accordingly or choose to play a different asset class, like options at an agro or moderate level. So if you want, pause this for a moment. You can take a look at the notes here. This is what we wanted to do. We did not get our opportunity in the S&P. We did not get the opportunity in the NASDAQ. Even though I was looking at both, they never come back to us. The Dow came back to us. The Russell came back to us. And by coming back to us, I mean specifically we had a retracement after the breach, in this case of a 5-minute gap-focused guideline. In other words, when we get the gap, we had a decent-sized gap in the Dow. We had a really good gap in the Russell. The breach of the high-low of the first 5 minutes is going to be very telling about direction. I also mentioned that we had a very kind of sloppy barometer, what I call our market barometer, not to be confused with market internals, which I by and large do not use. If you're playing momentum, use them. But mostly what you're going to see me put out as trades are exhaustion trades. The market internals, your tick, trend, advanced decliners, put call ratios, things like that, even your VIX to a certain degree, those are going to be better for momentum players. I think the VIX actually works out really well for exhaustion traders as well. So what do we have today? We had yen strength, bond strength, VIX strength, but we had Canadian dollar strength and Australian dollar strength. Well, when I kind of group all those together and I say, well, which one, if I were to put them on a scale, am I leaning towards risk aversion, which is sell stocks, or am I leaning towards risk appetite, which is buy stocks? We were clearly leaning towards risk aversion. And then additionally, we had the different breaches to the downside of our high-low ranges. And boom, that gave us the direction, that gave us the confidence, and there came the setups, okay? I will attempt to, when I can, alert day trades. That's not really what I do all the time, but when I can and I feel it's going to be, from a timing perspective, realistic for traders not in the room to follow along, not in the room to be able to follow along, right? I'll send them out, but today was pretty tricky. And but what I will do is I'll very clearly put all these posted in the room. Like we had this posted, this exact note posted on the screen for everybody to see throughout these throughout the decision-making minutes of our morning. All right, so there's that. Additionally, I mentioned Google could be an interesting one. Google at the top of the range tomorrow. I mentioned that in the free video. We're going to be day trading all over again. I'd love to see another gap. Gaps have been very good to us. In fact, when I don't see a gap or some kind of gap open, I'm a little disappointed because the probability has been higher when we get a gap. The probability for a cleaner setup has been far better. All right, so I'd love to see that. Again, I'll review the gap rules. I'll review what it is that I like to see in terms of size of the gap, and then what I do with the first, say, 5 minutes and how we play those breaches. Okay, I'll go through the whole process. In the meanwhile, crude is going to be an interesting thing for us to watch. I'd love to maybe get short RBOB if we can rally on the EIA tomorrow at 10:30. And then additionally, we had an interesting move in gold today. Let's open up the gold contract. And you'll see that we moved down a little bit more. I've mentioned that the 13 is a little aggressive. I'd like to see a 21 EMA to 34 EMA pullback. Let's come on down into the wave. Heck, let's test the value area low. That would be fantastic, and we will get long gold once again. What about our bond? I do want to get long bonds, gang. And again, today was not what we want to see. Now, I've been talking a lot about a 1 to 1.5 point sell-off in order to buy the calls in TLT or even ZB. So when you see the market moving lower, bearish momentum, down towards a 13, down towards a 21, or even just 1 to 1.5 points of a sell-off, that's going to give you an opportunity to get long TLT, You see that? down move, even that small move is going to give you a brief opportunity for some bullish follow through. It's really important if you're playing futures, options, or the ETF options or the stock options to use volatility. It is your secret weapon, gang. It absolutely is, and we utilize that. We capitalize on that in the room. Finally, I know there's a lot of questions about things like GDX. Gang, if we get movement in the GDX, I still have some time. I'd like to get out of this. Clearly, the 1700 level on GC, which I happily shorted twice to 100 to 200 point sell-offs. The third time, I'm kind of grateful that we went with GDX and not gold. But that's the counter trend play. Sometimes I'll do it and sometimes I'll get caught. This time, clearly it was the latter. But for the most part, I really want you guys playing with the trend, not counter trend. And there's a really good example of why. I don't mind being the warning. That I played that twice in a row, so I don't mind taking a small hit. I went 2 for 3. That's good stuff. But, it really is a lesson. What I want you to take away from this is, Rog, did we have to short gold? No, we really didn't. But again, like I said, when gold was in chop, it worked really well. But overall, I think if we can get a couple down days in gold, if we can get a little bit of a sell-off in GDX, if I can get out at Unster with a little bit of a loss, I'll be happy to ditch that play. And now, by the way, that we've reorganized into an uptrend, double green, I'm going to be looking for those pullback buys. So this is much cleaner, much, I think, better an environment for our pullback buys in gold. All right. And by the way, that will open up GLD as well. I'll see you in the next update.